The FASB Statement Number 123 was issued in October of 1995, and it's entitled Accounting for Stock-Based Compensation. This is a bit of an older statement since it's 20 years old, and it's not as recent as some other ones, but hopefully you will see its impact on financial reporting. FASB 123 defines a fair value-based method of accounting for employee stock options. The fair value just means the value at the date the stock was granted. This is a preferred method of recording, but the intrinsic value-based method is also allowed. The intrinsic value is the actual value based on all aspects of the company and not necessarily the market value. Here are a couple of ways that companies award stock-based compensation. The first is stock appreciation rights. This means employees receive cash compensation in the form of stock that they will then sell. This is usually correlated with an increase in the stock prices. The second option, the performance method, mostly involves upper-level management, and stock can be used as an incentive or bonus when the company performs well. The recording of stock-based compensation is what has gotten companies into trouble. The stock-based compensation should be recorded as an expense that is allocated based on the methods used. Because of the matching principle, expenses need to be recognized in the same periods as the revenue they helped generate. This is where reporting was going awry because companies were able to record stock compensation wherever it worked the best for them. Accountants need to disclose which equation they are using to calculate the value of the stock for full disclosure purposes. Stock compensation isn't brought up until Chapter 17 in our textbook, but here's what it has to say about the topic. Stock compensation is usually for upper-level management. This means that it was probably violated in the upper levels of the accounting department and possibly even CFOs. That shows a need for these regulations also. There are a couple of different methods in recording the stock on financial statements. The first is a simple stock-based plan. The equation that needs to be disclosed is the total compensation expense equaling the number of options granted multiplied by the fair value of each option. For this plan, the expense of the stock needs to be allocated throughout the time frame that the employee is with the company, given that the employee will contribute to the revenue that the company generates in order to give out the bonus stock. The second plan is the performance-based stock. The equation that needs to be disclosed is the compensation expense equaling the fair value at the grant date multiplied by the number of options that are probable to be awarded. The value of the stock is then reevaluated at the end of each year and then adjusted accordingly. All of these methods and rules are just to preface you to the regulations of FASB Statement Number 123 and how it will affect the reporting of employee stock within companies.